With that, Joe, I turn to you. New month, very strong year. November, historically the strongest month. But is it now time to maybe shift your strategy after we saw AI and the tech trade move the markets higher last week?
Well, it depends what your strategy is. But overall, when you're looking at the market, it is now a much more difficult environment than it was 30 days ago. 30 days ago, you had the benefit about speaking about the broadening opportunity, speaking about the variety of different sectors that were working. It appears as though in the last week, for whatever reason you want to cite, the strength of earnings, the relationships, new agreements with OpenAI, find what you wish, but it is very clear that we are back to that concentrated market once again today. S&P equal weight's down 50 basis points again today. That's a difficult environment for portfolio managers because as a portfolio manager, you are managing risk most importantly. And when you're managing risk, it's difficult to say I'm going to own 7 stocks in a portfolio and basically that's it. So it's a different setup coming into this month than it was 1 month ago because you're not getting rewarded like you were 30 days ago for the broadening out.
Yeah, I think you're speaking some of your own struggles. As someone who runs an equal weight strategy, you're seeing this kind of concentration in the market.
It is clearly frustrating. We'll talk about that a little bit more. Fortunately, we're okay today, but we're certainly not going to compete with the S&P 500.
All right. Kate, Joe's mentioned in the last week or so, if you look at the last month or so, if you look at the equal weight, underperforming by quite a bit, down more than 2%. You look at momentum, that's underperforming in the red, and even dividends. A lot of people said it's time for a flight to quality. Even dividends, if you look at the SDY ETF, that's underperforming. Are you concerned about this concentration when it comes to tech and the fact that all these other plays, well, at least the first two that we saw have relatively strong years so far, seem to be underperforming over the last few weeks?
Well, look, I'd be a lot more worried about this market as we get into the last 2 trading months of the year if what was driving the market was not fundamentals, right? And the truth of the matter is these large mega cap companies, it's beyond just the Magnificent Seven, into all of the tech and tech adjacent leaders are putting up great fundamentals. They're producing free cash and they're continuing to manage through a challenging investment environment. Like, if we were just about multiple expansion in 2025, I would be a little bit more uncomfortable. But I hear the point here around the equal weight versus the market cap weighted S&P. In fact, we did a study of this just over the last couple of days where we showed that really since 2023, there have been only 2 months where the equal weighted S&P has outperformed. And when we look at this on a Z-score basis, we have a 3 standard deviation outperformance of market cap weighted stocks relative to equal weighted. So as uncomfortable as that is for portfolio managers, and I completely hear that, I think we have to stay really focused on the large cap free cash generators, which unfortunately are the bulk of the market cap.
All right. Carrie, you feeling uncomfortable at all? You feel uncomfortable with your tech winners powering your portfolio, powering the market?
Well, I would say that the concern is that the free cash flow of these mega caps is not as great as it was. They're borrowing money. They're all issuing debt. They're using hundreds of billions of dollars in order to pay for their AI build out in whatever way it is, buying chips or paying for a data center. And therefore, we're relying on these companies to push the market higher and propel it when the free cash flow and the earnings growth that has supported it is not as strong as it was. And how can it be when these are the biggest companies in the world? They're the biggest companies that have ever existed. They justify the size that they are, but it's a concern. And the rest of the market that was trying to participate has failed to participate. I mean, that broadening, which people were so excited about a few months ago, just disappeared. And we were not big adherents of it, but what we believe in is that it's important to diversify your portfolio, not own 8 names, each of which is 10% of your portfolio, and then 2 other names or 3 other names in there. I mean, that's not being a portfolio manager, but it just hasn't worked. Therefore, these companies, whether it's Meta, Google, Amazon, Microsoft, Apple, they have got to continue. There's more pressure on them, and it would be better if we saw a little more spread of that, and that's why the market could correct. And we wouldn't be surprised.
Sorry, Steve. Are you saying that's a warning signal? Because it's odd enough that you say that today. Bank of America out with a note saying that right now companies are spending about 94% of their operating cash flow to do these build-outs when it comes to CapEx, if you subtract dividends and buybacks. So is that a concerning sign that they're spending so much of that cash flow in this one area?
Sure. Of course it is. Now, it doesn't mean it's going to happen, but yes.
Is the borrowing concerning? We're talking about Meta, I'm assuming, borrowing money. If the demand is there, is it concerning that they're borrowing the money?
Of course it's concerning, because when you're generating $100 billion and then suddenly you're borrowing $5 billion or $10 billion, yes, of course it doesn't mean it's going to happen this quarter, but we have to make sure that they begin to generate revenue and profitability from what they're spending on.
Steve, I want to come over to you. By the way, Jim Lebenthal in here saying it was just financial engineering. I believe that's what he called it last week, that it wasn't such a big deal. Basically, that's what you learn in business school, that the borrowing wasn't concerning to him necessarily.
Financial engineering is never a good term. Never.
I disagree with a lot of what you said. First
No,
of all,
you don't.
First of all, running a concentrated portfolio, I'll take the words of some of the greatest investors of all time, like a Buffett. Diversification is the enemy of performance. And we've seen that time and time again. And perhaps that's why 75% of portfolio managers underperform the S&P every single year. And it's not the same 75%. So I prefer a concentrated portfolio. And am I worried about a concentrated portfolio? I'm always worried about it. Anytime I have anything at risk, of course, there's concern. Right. But that question's been asked so many times over the last 5 years that, eventually it's going to be right for a nanosecond. Maybe we saw that nanosecond, but longer term, you go with permanent compounders, you go with Fort Knox balance sheets. And by the way, putting debt on a balance sheet when it's not an issue what your coverage ratios are is a good thing, because it's leveraging your returns. So I'm a fan of debt on a balance sheet for companies that can afford to pay it, and I don't look at it as a weakness. Now, in terms of the mega cap, what we saw were some mixed earnings, Meta being, I'd say, in terms of stock reaction, dog of the group, but they're doing exactly what I want them to do. They're investing in the future. So I took the opportunity to put on Friday a small trading position. It's already a big core position for me, but I'm looking to take advantage of it, as I did with Google back then. So, coming into this month, as Joe points out, it's a different game, but it's a different game because the Fed, is saying, I'm not guaranteeing you that we're going to cut rates. And that changes it, and that also limits the broadening of the market, in my view.
By the way, Kate,
that's well said. And my opening remarks are not to suggest I think the market's going down. I actually think you're going to get the continued. You will get the continued chase for performance, but I think Steve is eloquently defining the environment. It's just a little bit harder in November than it was in October, because you can't come on the show and say, "Oh, the financials, they're going to be a great place to be."
Don't fight the Fed,
right? And you got the earnings, they delivered in the financials, but you did not get the price reaction thereafter.
That's right.
That's a challenged environment.
Okay. So, not a foregone conclusion to you. That's a significant departure from everything else, data dependent. And Kate, I saw you nod. I mean, just not a foregone conclusion. That's just a total sea change in your mind when it comes to the Fed?
Well, let's be clear. I didn't think October was a foregone conclusion, despite the market pricing. And no one was asking me to vote as part of the Fed. But I was looking at the data, and the inflation data, both the official stats as well as what we were hearing from companies, was suggesting that inflation was percolating, that lots of kind of third-party and alternative data sources that we look at in terms of prices of imported goods were actually going up over the course of October. It wasn't necessarily an environment where, if the Fed has a dual mandate and they care about both sides of it, that it was clear to them that they should be cutting. And I think that's what played out last week. And we're going to have this litigated in the media over the next 5 business days. We have 12 different Fed speakers coming out to talk to us, telling us their specific views. But I think a more consistent debate, as opposed to an expectation of Fed cut after cut after cut, is going to be more of the rule for the end of the year.
Don't we get to a point, though, even if the Fed doesn't cut in December, where the market dismisses it and says, okay,
yeah, that's a one-off.
In May, we've got a different Fed chair, we've got a different disposition on the Fed. They almost is not going to listen to the message of the Fed. At what point?
Well, I think we're going to have to see. There are people who have aligned themselves with this administration on the Fed right now who also said it wasn't as much of a slam dunk to cut by a large amount in October. I want to believe in the independence of the Fed and the consistency of the way that they evaluate the data, both on the inflation and the labor market side, to make their decisions, regardless of who is put in the chair. So I'm going to continue to believe in the institution for the time being.